Hello everyone, this is Sebastian McMahon from IA Financial Group, and I'm back with the weekly economic review for the week ending June 6th, 2025. So the title of the review this week is Honeymoon's Over. Of course, it relates to the spat that we've had between Elon Musk and Donald Trump on Thursday. Are there, beyond the entertainment effect here, are there any consequences from this? Well, maybe because, the midterm elections in 2026 could be impacted if there's a spat between the two. Elon Musk had, hinted that he planned to spend money again to help the Republicans consolidate their power there. So maybe there's a change here. Also, Mr. Musk being so influential, and of course with his social media platform, if he goes on a crusade against the one big beautiful bill, well, that could change the odds of the bill actually passing. That could derail the economic agenda of Donald Trump. So it could have some economic and market consequences here. So we'll see. Today we're hearing that there would be a call between the two to try to, make amends. We'll see what comes out of that. But as I said, honeymoon seems to be over between the two. So before digging into this week's news and data, let's look at this week's markets at the close on Thursday. Negative returns for bonds. Interest rates continue to rise in the U.S. There's this fear of any type of fiscal incident in the U.S. With the deficit that is already wide and would be widening with this bill. Also, the economic data has been a bit better than expected, so that pushes the rates higher. For stocks, the outperformance of emerging markets, especially China, continues. The TSX continues to do pretty well. It was a positive week for US equities. Of course, if you hold any Tesla stocks in your portfolio, maybe the week was not so kind to your portfolio, with a pullback of 14% on Thursday. But if you go again year to date and you look at everything in Canadian dollars for Canadian investors, there's still you still have close to 8% on the TSX, about 13% for EFI, or 12% for EFI, and you're still underwater for the S&P 500. And the outperformance from between Canada and the US in Canadian dollars is about 11%. Between EFI and the US, it's close to 16%. So you're still better off being invested outside of the US rather than in the US on the stock market if you're a Canadian investor in 2025. Price of oil higher, of course, helping the TSX, helping also the Canadian dollar. Also, the USD continues its secular decline. So CAD and Euro continue to outperform, and gold continues to be a good asset for any kind of risks, geopolitical risks in 2025. Maybe just a quick plug on the latest monthly macro and strategy piece that we put out. This one was more, let's say, an update of what's been happening in the markets and in the economy over the last 2 months. Of course, things are getting, let's say, less bad since April. This was enough to push the stock market to close to the all-time highs in the US, beyond the all-time highs in Canada and in Europe. And also, we're discussing here the new story, the new narrative, let's say, about the fiscal situation. It's not the new story, it's the story that's been evolving for more than a decade now, but still the narrative starting to focus squarely on the fiscal situation, the interaction between trade and fiscal. And now the bond market is starting to invite itself into the conversation with some worries that there are more risks to the fiscal future of the US than maybe was discounted in the markets recently. So of course, and on the right you have the table where you show where you see our positioning. So we strongly encourage that you take a few minutes to go read our latest monthly. Now, an update on tariffs. It's been a busy week. Trump did put into effect the 50% tariffs on metal, so that's steel and aluminum. We still believe that this is a very bad policy for the US economy. Prices for steel and aluminum will go up. The steel and aluminum producers are very small in terms of weight in US GDP, but the manufacturing sector, those that are in the transformation of those metals, take a very important share. So overall, that should be inflationary for the US. That should remove some growth. And of course, if you're a Canadian exporter, likely there's going to be a slump in your export numbers. But in the end, maybe the US can produce a bit more steel domestically basically, but aluminum is something very different. The cost of electricity is very important in the price of aluminum. So we'll see how long it holds, but maybe that's what's behind the stance from Mr. Carney, that yes, this is illegal, but they will take some time to consider next steps, because likely this is not tenable for the US. Mr. Trump talked with Mr. Jinping, China's president, this week, trying to hash things out. So that remains a very active risk, nothing new here. Countries were given until Wednesday to make their best offers to the US to avoid tariffs. Interestingly, we're not hearing anything on this from anyone, so I don't know if countries really send their best offers, but this is one of the reasons why, don't forget that there was a 90-day pause on the Liberation Day tariffs that will end on July 9th. This is about a month away. Now they're asking for best offers. So are we headed for a redux of Liberation Day, where Donald Trump just sends tariff numbers to everyone, likely lower or equal to what was sent in early April? So again, the stock market is close to all-time highs in the US now. There's too much complacency now. Is this going to be a very topical issue soon that could lead to some volatility in the markets? Maybe. So those are some risks. So the risk-reward ratio is always what we focus on. And right now, we still think that rebalancing and being invested outside of US equities mostly makes sense. Finally, we're hearing good news that Mark Carney and Donald Trump are in direct talks over trade war. So if that's the case, of course, that's bullish for the Canadian dollar, bullish for the Canadian economy. So it supports our thesis that the Canadian dollar could continue to appreciate here. So again, no week is boring on the tariff front with Donald Trump at the helm. So the Bank of Canada now sidelined through the summer. That's a question that we're asking, but we think the answer is yes. 275 and a hold is the decision from the Bank of Canada. We do believe that they are flying by sight because there's just so much uncertainty, and it's reasonable for them to fly by sight. It's hard to make a forecast. You cannot be forward looking if you're a central banker. And they look at inflation expectations from surveys, which is the right thing to do. And these are showing some upside risks. So you don't want to create inflation and have after that to turn back and try to fight that inflation by cutting and then hiking again. You want to avoid that. And they're talking about the conversations that they're having with businesses, which are showing that maybe we can start to remove some tail risk scenarios, but still there are some risks that are inherent. So I think that likely the Bank of Canada is in a good spot at 275. We still think that they will be cutting some more. Will they go all the way to 2% as we expected? Maybe now the bar is high, because if they skip over, as they hold again in July, then there's 3 more decisions to end the year. Will they be cutting 3 times in a row starting in September? Maybe, but it's getting less likely. So will we end the year at 225, 250, 2%? We still think that there are some cuts to come from the Bank of Canada, but likely the next one could be in September. The economy in the US is stalling. When you look at soft data, when you look at survey data, you're seeing a downbeat consumer, you're seeing a downbeat business sector. The economy is still holding, so we're not, on the verge of a recession. But when you have readings like these that we got this week, so ISM manufacturing on the left, ISM services on the right, remember that the 50 line is the threshold for growth. So anything above 50 is growth, anything below 50 is a contraction. You see that manufacturing is in slight contraction, and you see that services, which was growing for a while, is not growing anymore. So it's looking like stagnation in the US. This is our call for the rest of the year. This is the scenario that we put in the monthly. The base case that we have some sort of stagnation. The bear case is a recession. We're not there yet, but stagnation seems to be confirmed by the data that we have here. But the most important data is the labor market one. And if you look at the chart here, you're still seeing resilience. So it's a very tough economy and market to call with all of the weight of this uncertainty. But if you look at the macro data in the US, you see good job creation. So the US economy continues to chug along. On the right for Canada, you had a disastrous March with the new tariffs coming in, and job losses in the car sector. But since then, you've seen an accumulation of 2 consecutive months of positive growth for the job market. That's even though there was a gain from the election, of course, temporary workers. But this seemed to carry over for May, so there seems to be some budding momentum here. But we want to be still careful. So it seems that the Canadian economy is already in a stagnation. The US is stalling, so headed towards a stagnation. But with all of the risks that are out there, we'll keep you posted week to week on how our view evolves here. So what we'll be watching next week in Canada, we'll have minor reports. So building permits and manufacturing sales. In the US, we'll have inflation data. Should be accelerating a little bit on the annual side, but not enough to lead to any concerns in the markets or to push the Fed to change its stance. And the confidence index from the University of Michigan should go sideways at very low levels. So very interesting macro picture. Week over week in 2025, the story tends to be kind of evolving, but uncertainty seems to be growing rather than shrinking. So we'll keep you posted on our views, but so far so good on the market returns. And again, if you were worried about your portfolios in early April, the market is giving you a great opportunity now to rebalance and make sure that you're positioned correctly. If and as is a possibility, we eventually have another bout of volatility that hits the markets, and we have some profit taking following these outsized gains that we've seen since early April. So this is a recommendation. So that's it for the week. If you appreciate the content, please share, and of course, come back again next week.